So one of the big news stories today, and there were many, but one of them is that the Bank of England has announced it's going to be reinstating its policy of quantitative easing, which is basically printing more money. And they cited the fact that there's instability in the debt markets, and therefore they're going to need to reverse course, print more money. And as what's happening right now in the U.S. is that the Fed is in the process of raising interest rates, and it's obviously wreaking havoc on the stock market. And their stated intent is that it's going to reduce inflation, right? So we're going to eventually not pay so much for gas. It's doubled over the last year. We're going to pay less at the grocery store. We're going to get these prices down. But basically, this thing with the Bank of England is that their central bank, again, the equivalent to the U.S. Federal Reserve, but in England, is capitulating. The U.S. Federal Reserve has not yet capitulated, and they remain so far with a stance on raising rates, which is where we are now. The point of this video is basically just to bridge the gap between what is perceived as, the financial markets, this thing that's detached from everyday life, bridge that gap and tie it to actually, what are the prices that we pay at the grocery store? What are the prices we pay at the gas pump? And what might we expect to pay in the next 6 months, in the next year? And a bigger picture, where does this all go? So basically, this is something that affects everybody, because we say, that's over there in England. It doesn't affect us. But what people sometimes don't look at is the fact that all these central banks work in concert together. So while they say that they do not coordinate, the European Central Bank and the U.S. Federal Reserve and the Bank of England do not coordinate, we've learned through history that often what they say is the opposite of what they are actually doing. So when they come out and say they're not coordinating with one another, they are coordinating. And so when we look at this, we go, well, where does this lead in the U.S., right? We say, we're removed from that, but we look forward, another month, another 2 months, where are we going to be? Will the Fed chair, Jerome Powell, capitulate and change it from his hawkish stance, which is, again, has been wreaking havoc on the stock market and also been driving a beginning of a panic in the debt market? And one way to look at that is the 10-year Treasury yield. It has been spiking, seeming like at out of control rates more and more. Yet, when this news came out today, you look at the U.S. 10-year, and it came down substantially to around 3.7, I believe. It was near 4. It was about to cross 4, and then boom, it comes down. So the way you can look at that inverse relationship is when the U.S. 10-year yield, and that's the basically what the interest that is paid on a bond when you invest in a bond. Whenever that's spiking out of control, it means that bonds are being sold off, and then whenever that number comes down, it means that that situation has been tamed by the Federal Reserve. So the Bank of England basically stepped in and said, all right, this is getting out of control, this sell-off in bonds. We're going to step in and start adding liquidity to the market, which is essentially money that's borrowed from the future, money they don't have, but it's a band-aid, at least in the near term. So you saw the stock market today do great, and the U.S. 10-year came down, and again, this is all connected. So where might this lead? Probably that the U.S. Federal Reserve is going to come in and start a similar course, which is to reverse the course that it's on now and say, well, we took a hawkish stance and we were raising rates, but basically that the debt market and the economy can't sustain it, so it's going to have to bring down the interest rate and start printing even more money that doesn't have out of the future, that is we pay back basically in the inflation tax, in the prices we pay for food, the prices we pay at the pump. Now, here in the U.S., prices we've seen actually really painful increases in prices. I mean, gas is where it's at now. It's a little lower, but I mean, in June, July, the gas had doubled from where it was a year and a half before. Food prices on average were up from between 15 to 30% on different basic staples, the things that we pick up at the grocery store all the time. So when the Fed in the U.S. does reverse course and they say, well, yeah, and they capitulate too because the debt market is becoming unstable and it's selling off out of control, then what is that going to result in? In the short term, in the weeks or in the days and weeks ahead, it'll be, oh, the stock market loves it and everything's fine again. But soon after, reality catches up, and then where does that show itself? In prices, in the prices that we pay for goods, basically, everything from basic commodities all the way even up to services, especially if they rely on transportation. For example, Amazon deliveries, right? I mean, the product might have a certain price, but then we forget about what's the cost to have the thing delivered and where is it being shipped from? All those trucks run on diesel, and a lot of the trains too. So prices of fuel affect basically everything, and more quantitative easing, which means more money printing of money that doesn't exist, that's basically being borrowed from the future and sold as a product of debt to us as a solution to the problem that we're seeing, is actually something that is inflationary and causes prices to go up even more. So I think what we're going to see is that prices are going to, into 2023, I mean, we haven't seen anything yet. Prices are going to spiral out of control, and this is something to be aware of ahead of time, because if you get out ahead of it, you can actually make sure you have some basic staples at home that you've bought ahead of time before the price of a bag of rice is triple what it was. You can actually insulate yourself a little bit from some of the consequences of this ridiculous trajectory that we're on, being driven by these central banks. So that's a brief rundown of it. A lot of the time one needs to have some historical basis for looking at it. The 1913, there was a book on it, The Creature from Jekyll Island, the creation of the Federal Reserve. 1971, when President Nixon took the U.S. off the gold standard, what this all means. But basically, in summary, prices are going up, and get ready.